Hi fellow investors, this is Charlie Tian. Welcome to my value investing class. From today on, I will be giving a series of talks which will be a value investing class series, and this is the first talk. Before I start, I want to introduce briefly about myself. My name is Charlie Tian. I'm the founder and the CEO of GuruFocuscom. We are now the world's largest value investing website. I came to the United States in 1998. I have 32 US patents. I founded GuruFocus.com in year 2004. Now we have more than 30,000 institutions and universities and individual investors from 121 countries in the world as our paying subscribers. I also wrote a book. It's called Invest Like a Guru. It was published by Wiley in 2017. You can find it online from Amazon.com and a lot of other websites. When we talk about value investing, of course, everyone will think about Warren Buffett. But if you want to really understand what value investing is, we have to start from Warren Buffett's mentor, the founding father of value investing, Benjamin Graham. And this time, I will use lots of real examples to introduce Benjamin Graham. And Benjamin Graham was born in UK, and he was called the father of value investing. And Benjamin Graham to the investment world is like Newton to physics. And we have a saying that without Newton, there's no light. And we can also say that about Benjamin Graham. Before him, investors think that the price movement of stocks is a random thing, is a random move, random walk. And Benjamin Graham brought the concept of value into the investing world. Benjamin Graham was a very smart kid when he was young and knows lots of languages. In 1914, when he was 20, he graduated from Columbia University. And after he graduated, Columbia University gave him 3 choices of departments and asked him to be a professor. They are philosophy, English, and math. And he didn't accept any of those because his father just died and he needs to support the family. So he went to Wall Street, and in 1923, he started his own investing company. In the following 6 years, Benjamin Graham did extremely well and got the performance was much better than the broad market. But in 1929, the crash of the stock market and the following Great Depression almost bankrupt Benjamin Graham. The US stock market lost 80% in the 4 years, and Benjamin Graham lost 70%. That painful experience made Benjamin Graham think, and make him think more about the safety of investments and how to make money in the stock market safely. That's why he created this value investing idea. He said that in value investing, there are at least 4 concepts we need to consider. First, it is intrinsic value. And second is margin of safety. Then there's a mixed market and the diversification. Let's talk about intrinsic value first. Benjamin Graham said, as a shareholder of a company, you should think that you are the partial owner of the business of the company. So if the company is Starbucks, maybe you own a portion of the coffee sold in a certain store. And if the company is Google, maybe someone made a search and a click on that search made money for Google, and that money actually belongs to you. That shareholder thinking is why Warren Buffett always drank Coca-Cola, and because he owns 10% of the company, and he drinks 5 cans of Coca-Cola a day. So every 10 cans of Coca-Cola drank by everyone, and 1 can belongs to Berkshire Hathaway. So if you think this way and you're a shareholder of Starbucks and you want to drink coffee, where do you go? Of course, you go to Starbucks. And to Benjamin Graham, the intrinsic value of a company is decided by the company's assets, the operations, the dividends, and the future growth. And when you think as a shareholder, when you think about the intrinsic value of the company, as a stockholder, you will not think that the price of stock is a random number, and you won't be very sensitive to the stock price changes. And Benjamin Graham pointed the second important concept is the margin of safety. He said that when you buy a stock, the stock price must be lower than the intrinsic value of the stocks, and at least lower to a certain extent. So if the company's intrinsic value is $100, and he's only willing to pay 60. And why? There are two reasons. One is when we estimate the intrinsic value of a stock, we cannot get a very accurate value. The second is the higher the intrinsic value is, the cheaper you buy, the safer the investment is, and the higher the possible return is as well. The third concept Benjamin Graham had was mixed market. Benjamin Graham pointed out, although you are the shareholder of a company, but you always have a partner, which is mixed market. And the mixed marketer is very emotional. Sometimes he's happy, sometimes he's depressed, sometimes he's excited, but sometimes he's just feeling low. And this mixed market controls the stock price in the whole market. Benjamin Graham told a story. He said, mixed market always want to trade stock with you. But because he's emotional, his emotion is not stable. Sometimes he's happy and only see the bright side of the world, and he will ask a very high price. But in other times, he's depressed. He's feeling low. He sees all the troubles the world is having, and he will ask a very low price. And his price can be very irrational and sometimes high, sometimes low. So the most important thing for you is not be controlled by mixed market. When he's not normal, and you can just ignore him. But when he's behaving in a way that's advantage to you, you should take that opportunity and trade stocks with him to get a higher return. So, but if on the contrary, you are controlled by the mixed market, and the results will be very bad for you. But Benjamin Graham thinks that although there is this irrational mixed market, but over time, a lot of times, sometimes, the intrinsic value will still be reflected on the stock price given by the mixed market. The third concept Benjamin Graham had was to diversify. And he said everyone needs to own at least 40 stocks. I will explain more about this in the future. In 1934, what Benjamin Graham was teaching in investing was written into a book. It's called Security Analysis. And this book started to influence everyone on Wall Street and a lot of individual investors. Among the ones who were influenced by Benjamin Graham was Warren Buffett. When Warren Buffett was 19, he read Benjamin Graham's second book, The Intelligent Investor. He said, this is the best investment book ever written. And it opens the world of investing to Warren Buffett, and his life was ever changed by that book. Even today, in interviews, in shareholder letters, he mentions that book all the time. He said, that book really changed his life. And he knows the book very well. He would directly point out in which chapter, which section, what Benjamin Graham said. He said, even today, whenever he opens this book, he still learns something new. Fellow investors, in this video, I introduced Benjamin Graham, his value investing concepts such as the intrinsic value, the margin of safety, and mixed market. In the next video, I will use real examples to teach you how to calculate the intrinsic value of a company in Benjamin Graham's way. And if you have any questions, please leave it in the comment area. I'll answer them when I get a chance. I hope this is helpful to everyone. Thank you all for the attention. See you next time.